Everyone is waiting for the housing market to crash. They've been waiting since 2022. But here's what nobody is talking about. Even if prices never crash, millions of Americans are being priced out of homeownership right now anyway. And it's not because of what you think. Today we're breaking down exactly where home prices stand, why mortgage rates are stuck, and the hidden costs that are quietly destroying affordability for everyday Americans in 2026. If you own a home or you're trying to buy one, this affects your money directly. And if this is your first time here, make sure you subscribe. Every single day, we cover the moves the wealthy make and how global events impact your money and your future. Let's start with the question everyone keeps asking. Is the housing market going to crash? Based on the actual data, the answer is no. Not now, and not anytime soon. The median home price in the U.S. right now sits at $429,020 to $26. That is up 0.9% compared to last year. Not a massive jump, but prices are still moving up, not down. For prices to crash, you need supply to flood the market and demand to collapse at the same time. That is simply not what's happening. There are currently 1.7 million homes listed for sale across the country, and that number is actually slightly down from where it was 12 months ago. Supply is shrinking, not surging. The crash crowd has been waiting, and the math just is not on their side. Now, what about foreclosures? Foreclosure starts are up 14% year over year, and that headline is getting a lot of attention. But here's what those headlines leave out. Foreclosure activity today is still below where it was and back in 2005. And during the last real housing crash, it took 5 full years from 2005 for foreclosures to peak, and home prices didn't bottom out until 2012. If you follow the same trajectory, a potential bottom would be somewhere around 2034, and that last crash required a full global financial meltdown to trigger it. The data is clear. Fannie Mae projects 1.3% home price growth in 2026. Reuters economists say 1.8%. The National Association of Realtors is calling for 2 to 3%. Expect flat to slightly positive. Boring, but stable. Now let's talk about mortgage rates, because this is where things get more interesting. The average 30-year fixed rate in the U.S. is stalling right around 6%, and the reason it won't come down connects to something most people never think about: the 10-year Treasury note. Mortgage rates move with what investors demand to lend money to the U.S. government. When that 10-year note was sitting at 1.4%, mortgage rates were at 3%. Now the 10-year is around 4.2%, and mortgages sit around 6%. And right now, that rate is actually ticking back up. Why? Because of the ongoing conflict overseas. War drives up oil prices. Higher oil prices push inflation expectations higher. And when investors expect more inflation, they demand higher interest rates to protect their money. The result? Your mortgage rate goes up, or at the very least, stops going down. Millions of Americans who want to buy a home or refinance are directly paying the price for a conflict happening thousands of miles away. That is how connected the global economy is to your monthly payment. If you want to understand how global events move your money and what the wealthy actually do about it, this is the channel. Subscribe and come back every day. But here is the part that most housing market videos completely skip over. Even if mortgage rates drop tomorrow, the affordability problem in America might not get any better, because the hidden costs of owning a home are exploding. Since 2019, property insurance costs are up 72%. Property taxes are up 31%. Read those numbers again. Even if your mortgage payment went down, these two costs alone are eating through any relief you'd get. And if you think renting protects you from this, it doesn't. Landlords are dealing with the exact same rising costs, and they pass every dollar of it down to you in the form of higher rent. You are paying for this one way or another, whether you own or rent. The Home Affordability Index in America is sitting just barely above 100 right now. A reading of 100 means a median income family can just barely afford a median priced home in the US, and that means living paycheck to paycheck with zero cushion for surprise expenses. Before the pandemic, that index was sitting between 160 and 170. The shift has been dramatic, and most people haven't fully processed what that means for their finances. One more thing worth understanding: where Americans are actually moving. People vote with their feet, and the data tells a clear story. California is the #1 state people are leaving. New York is #2. Illinois is #3. And the #1 destination is still Florida, despite the narrative that people are now leaving there too. More people are still arriving than leaving. Texas was a massive migration magnet for years, but it has now reached equilibrium and is stabilizing. And here's the interesting wrinkle. While California as a whole is losing people, Sacramento is the #1 city in the entire country that people are moving to. Something is shifting inside California that's worth watching closely. The migration of wealth, how the top investors think about real estate, inflation, and broken affordability. That is exactly what we cover in our investor series. Check out our Warren Buffett episodes and see how the greatest investor alive thinks about markets like this one. The housing market in 2026 is not crashing, but it is not getting easier either. Prices are holding, rates are stuck, and the hidden costs are quietly crushing millions of Americans who are just trying to build something. If you want to stay ahead of this and make smarter money decisions in an economy like this one, you need to be paying attention to what's actually happening. Subscribe, hit the bell, and we'll see you tomorrow.